Have you been buying the wrong stocks? We're going to take a look at two big REITs, Realty Income as well as VICI Properties, with slightly different performances over the last few years. We're going to combine them, take a look at both of their dividend safeties. We're going to get into their financial metrics. We're going to see, is there any insider buying or selling from either of these companies? And we'll also compare what the institutions of each one of these companies are doing. Are there any signs of which one is the better REIT for the future? We'll also jump into the valuation of both Realty Income and VICI Properties to find out which one is giving us the bigger margin of safety, which one has the most upside from Wall Street, and whether or not we should be ditching one of these REITs for the other. Now, firstly, we can look at the historical performance of Realty Income. Now, over the last year, it is down 21%, and over the last 5 years, down 23%. Now, this doesn't include those dividends reinvested, but nonetheless, it is still a very poor performance. We can see it is trading towards the mid to lower end of the 52-week range, with the yield now pretty much right there at that 6% level and a P to FFO of 12.5. Now, when we compare that to VICI Properties, yes, it is also down 14%, but given this was founded and in fact listed on the New York Stock Exchange around 5 years ago, since then it is up 38%, whilst we saw Realty Income down negative performance. We also see it pretty much in the mid to lower end of the 52-week range, with a yield just slightly lower at 5.68 versus Realty Income's 5.99, and we can see the forward P to FFO of 12.32. So we can see over the last 5 years with VICI Properties a plus 38% return, whereas Realty Income a negative 23% return. Does that bode well for the future and the current performance and financial metrics of either company? Let's start off with Realty Income. Dividend safety 80, it does look to be safe. Market cap 37.2 billion, it is a large cap company. Now, when we compare that to VICI Properties, it sits at 50, borderline safe, and a market cap of 30 billion. So we can see Realty Income does have the safer dividend by quite some margin. So let's take a look at the essential market and value metrics from the last recession. Well, Realty Income, they increased the dividend during the last recession of 07-09. They had above average growth, and they also outperformed the S&P negative 43% versus the S&P's negative 55%. Now, when we compare that to VICI Properties, we did mention it wasn't listed until 2018. Therefore, we don't have any comparative data. So let's get into the dividend growth. So the dividend growth of Realty Income, we see 4% increase over the last full year, which isn't too bad. Remember, we do say on the channel a minimum 4% just to keep in line with inflation. Otherwise, if any lower in your dividend, salary or other income producing assets, you are effectively taking a pay cut and losing purchasing power. Over the last 5 years, a 3% increase year on year, so below inflation. Over the last 20 years, around 5%, so mid-single digits. Now, when we compare that to VICI Properties, VICI does have a higher margin, around 6.4% on the dividend growth just in their latest increase, and over the last 5 years, it sits a lot higher in the high single digits, around 7%. So VICI Properties does have a higher dividend growth as in comparison to Realty Income. Now, taking a look at dividend yield theory, we can see that for Realty Income, we have a double sign of undervaluation, 5.89 on the yield versus the 4.43. And for those that don't understand dividend yield theory, it essentially states that the company is undervalued when the current yield sits above the 5-year average. We can also see for Realty Income, forward P to FFO 12.6. It is below the 5-year average of 17.8. So there's a double sign of undervaluation. We then compare like for like VICI Properties, and we can see here another sign of undervaluation, 5.62 versus 5.03. Likewise, 13.3 on the forward P to FFO versus the 5-year average. So both REITs look to be undervalued on both the yield basis as well as the forward P to AFFO. So let's jump into their earnings, and what we can see for the earnings, or in fact adjusted FFO, funds from operation payout, which is what we use for REITs, we want to see below 90%. For Realty Income, 90% was hit only once in 2013. Since then, it has been decreasing, 76% in 2022, 76% expected in 2023, and pretty much around that in 2024 as well. Now, when we compare that to VICI Properties, we can see pretty much consistently around that 75% mark. What you'll notice for hotel REITs, we are a bit more specific around the 75%. So nice to note for REIT, it is very, very consistent at that level. And we do see that expected in 2023 and 2024. Moving on then to Realty Income's adjusted funds from operation per share, we can see increases pretty much year on year very consistently. 2023 and 2024 expected to go higher, so there is that consistent growth. Now, when we look at it at a per share growth basis percentage format, it is pretty consistent around the mid-single digits every single year, although we note 2023 and 2024 around the 3 to 4% mark. Now, in comparison to VICI Properties, we see it go from 37 cents in 2017 to 193, and again expecting to increase in 2023 and 2024. So when we look at the percentage format on the adjusted FFO per share growth, in fact, the last few years we see some strong double-digit growth. 2023, 15%, 2024, 5%. So over the last few years, it looks like VICI Properties has had the much stronger FFO per share growth. Now, one thing that you will know if you do invest in REITs is that they dilute your position and they do issue a lot of shares. And as we can see for Realty Income, it has increased from 192 million to 670. We always say on the channel, Realty Income is one of those REITs that does dilute your position at a very, very rapid rate. Now, when we compare this to VICI Properties, what we can see is they too dilute your position, and at a very fast rate as well, 228 million to 998. So in my personal opinion, there is no clear difference between either of these REITs. Both of them, as shareholders, will dilute you very quickly. So then moving on to the ROIC, which is one of my 7 golden dividend metrics. What I'm looking here for typical companies, 10% or more. For REITs, around 3 to 5%. That gives me faith that management are effectively allocating their capital. And if you want to see the other 6 golden dividend metrics, I do free weekly newsletters talking about different topics. All you have to do, click on that pinned comment below, completely free. In fact, in the more latest edition, we've run through companies where insiders have been buying a lot of shares, as well as other companies where insiders have been selling a ton of shares. So ROIC for Realty Income, remember 3 to 5%. 2022 and 2023 at that 3% level, so right at the bottom of the minimum that I want to see. In terms of VICI Properties, what we have here is very strong. In fact, over the last few years, between that 5 to 8% level, with 2023 coming in strong at 8%. So it is nice to see management are allocating that capital a lot more effectively than O. We then move on to the operating margin, and for Realty Income, we can see very strong around the 40% consistently. It did dip slightly in 2022, but even the more recent period, 41% is looking healthy for this real estate investment trust. However, when we do compare this to VICI Properties, we see it is a lot higher, 63% in 2022, which is the lowest it's been over the last few years, and that's higher than the lowest, or in fact, that's higher than the highest point of Realty Income, 2023 sitting at 91%. We then move on to what is a very important metric, especially for REITs, is the net debt to EBITDA, earnings before interest, tax, depreciation, amortization. Now, this correlates to 2 things, the dividend safety as well as the balance sheet strength. And we want to see below 5.5 for REITs. These are the number of years it will take the company to pay off all of their debt net of cash on hand. 5.97 in 2023 for Realty Income. It is higher than the maximum we want to see. In positive news, it is coming down, expected to 4.57 in 2024. In comparison to VICI Properties, which is a hotel REIT, so we're looking for around 3.5. We do see it in 2023 at 6, so it is relatively high. 5.57 though expected in 2024, so it is expected to drop, hence why we can see even at this level it to be borderline safe above, as it is quite some way away from that 3.5. Nonetheless, 6.02 in 2023 versus 5.97 for Realty Income in 2023, there isn't too much between them. So in terms of insider buying and selling, we've run it through a screener for VICI Properties and Realty Income. So over the last 3 months, the only activity has been some insider selling by the director A. Larry Chapman for Realty Income. He sold around 3,500 shares of $200,000 worth. Now, as we always say, insider selling isn't necessarily a bearish signal. Many reasons, whether it's personal or financial, for them to sell. But again, just being transparent, we have run both companies through, and the only thing we could see was this sale. So let's take a quick look before we jump into the valuation and see whether or not institutions are favoring one company or the other. We have Realty Income, 79% institutional ownership, 1.76 billion worth of sales by these institutions, 6 billion worth of buys, so they are buying a lot more than they are selling. And as we can see, each quarter, Q1, Q2, Q3 and Q4 of 2023, more buying by these institutions than selling. Now, when we take a look at VICI Properties, the institutional ownership sits higher at 97 billion. We see 2.59 billion worth of sales with 5.21 billion worth of buys, and we can see, similar to Realty Income, Q1, Q2, Q3 and Q4 institutions have been buying more than they have been selling. So let's take a look now at the valuation of both companies. And as always, if you do enjoy the content and values being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. So typically on the channel, we would run through each one of these models. For today's episode, let's get straight into the intrinsic value. And for Realty Income, we get to a value on today's episode at $65. So margin of safety, what we typically use is 10%. And as always, that is if it meets 3 criteria: wide moat, strong financial metrics, good forward-looking data. At 10%, a buy up to $58. At 15%, a buy up to $55. And we keep going till it's near the current trading price. So it isn't too far off a 20% margin of safety. We're talking around 20-25 cents shy. So you could argue Realty Income has a 20% margin of safety. In terms of Wall Street and what they forecast over the next 12 months, well, they have a price target of $62 with upside of 19%. So they do believe this to be a fairly strong buy. Now, when we do compare this to VICI Properties, again, we run it through the same valuation process to get to its intrinsic value of $37.50. So again, we start off with that 10% until it reaches the current trading price or thereabouts. And we can see for today's episode, it is over a 20% margin of safety, not there yet at 25. So similar to Realty Income, we believe that both VICI and O have around a 20% margin of safety. In terms of the Wall Street forecast, well, they see a price target of $35 and upside of 19%. And when we compare that to Realty Income, again, pretty much both of these companies, we see a 20% margin of safety. And in fact, Wall Street, coincidentally, see both of them to have 19% upside over the next 12 months. Now, we were looking at their price movements over the last 5 years. Remember, VICI Properties was only listed on the New York Stock Exchange in 2017-18, so it has only been around 5 to 6 years. On that performance, VICI Properties has significantly outperformed Realty Income, VICI Properties with a positive return, Realty Income with a negative return. Now, what's also important to understand is that past performance isn't an indicator of future performance, and one would expect with the acquisition of Spirit Realty Corporation that Realty Income will be a lot stronger moving forwards. As always though, let me know your thoughts in the comments below. Do you favour one of these REITs over the other for the long-term growth and their performance, or do you have both? Now, full transparency, I do hold both of these companies. I do believe they are strong REITs for the future as well as just currently holding them for their dividend, but I'm interested to hear what you think. And as always, if you enjoyed the episode, smash that like button. Don't forget you can grab a copy of this valuation model to get to the intrinsic value and acceptable buy price of companies in your own portfolio by clicking on that pinned comment below, as well as finding out prices for those on your watch list. As always, have a great day. See you on the next episode and take care for now.